And speaking of home prices, when we look at what's going on right now with the national home price data, home prices now are actually going negative nationwide when you account for inflation. And inflation is a very real problem for all of us. We know it's not this imaginary thing that no one is worried about. In fact, it's the number one thing that basically everybody's worried about, combined with the job market. Now, as of the most recent data from Cotality, which used to be CoreLogic, home prices nationally only grew 1.5% in August compared to 1 year ago. And that is now the weakest annual increase in over 2 years and is well below the current rate of inflation, which we just got the recent CPI reading for September, which is at 3%. So inflation is growing at double the rate of home prices right now. And real estate has always supposed to be a hedge against inflation. At least that's what so many people were told in the past. Well, real estate is no longer keeping up with inflation. In fact, it is now going negative when you account for inflation. And keep in mind, these are government statistics. The CPI data has been wrong forever, okay? And the real inflation data is much higher than what they want to admit. So if we just go by the rule of thumb that the real inflation numbers are double the CPI data and real inflation's at 6%, home prices are only increasing at 1.5% per year, that means you're actually losing 4.5% per year on the value of your home right now if you're a homeowner when adjusted for inflation. Think about that one for a minute. And think about this. Owning a home is most Americans' biggest financial asset that they have. And even though the stock market continues to break new record highs, only 43% of Americans report owning stocks, according to the Federal Reserve. So only 43% of Americans are reaping the rewards of these record high stock prices. But national homeownership rate is at 65%, so a lot more people own homes than stocks. But your home is now losing value year over year when adjusted for inflation, unless it's increasing far more than that. Like, for example, if you have a house that went up 10% in value in the past year, well, then obviously it's beating inflation. But in general, these are the numbers we're talking about here. So it's game over for the housing market, guys. Buying a home is no longer a hedge against inflation. Investors have no real incentive to buy homes anymore, especially since the rent prices can't even keep up with the cost of ownership anymore. So who's going to buy at these prices? No one has an incentive anymore. And by the way, I walked over here to Land's End real quick. I have to show you guys the view here. It is absolutely stunning. Take a look at this. You got the beach down there, the Golden Gate Bridge, and the Marin Headlands, all with the water here. Couldn't ask for a more beautiful day to be here. I'm really glad it came. And one thing that a lot of people haven't thought about because of this situation with housing going down in terms of inflation is that this can actually have an impact on how homeowners view their financial well-being and ultimately impact spending patterns in the economy. What we saw over the past few years was this massive wealth effect. People saw their portfolios rising, people saw the home values rising, and made them feel very rich and confident to spend more. But now all of that is coming to a reversal. Even if you are seeing exploding values in your portfolio, a lot of people are skeptical that it can continue in that direction for a whole lot longer and are still holding back on the spending. According to Zillow's most recent data, they say the typical home value as of September is $364,900. But they also noted that its Zillow Home Value Index showed flat home prices rising 0% from the same month 1 year ago. So according to Zillow, home prices are not going up at all right now, whereas according to Cotality, it's 1.5%. Either way, inflation is killing any gains you might or might not have. So is this exactly how things went down in 2008 when people lost 30 to 50% of their home value over the course of 5 years? Not quite, but it's actually looking like it could be worse than that because this decline in home prices is being hit with a double whammy, guys. Not only are nominal home prices coming down in more than half of America right now, but when adjusted for inflation, it's coming down much faster. And that's a problem we actually didn't have back in 2008. The inflation wasn't out of control back then like it is now. And so homeowners today are seeing a loss of equity from both home price declines and inflation. And if you want to know the true value of how much homes prices have been coming down, when you look at US home prices priced in gold, honestly, home prices have been coming down since the early 1970s, guys. Take a look at this chart here of home values in US dollars versus gold prices. And right now, home prices are just as low as they were back in 1980 when priced in grams of gold. And it was actually higher in 1970 than it is today when you price your home in gold. So what that tells you is that home values have been declining for the past 50 years when priced in real money. And everybody kept looking at the green line like, wow, home prices keep going up over the long run. And when you price it in dollars, even the 2008 crash looks like a blip on this map, and it just kept going up after the recovery, which it did. But who cares, because the value of the dollar is turning into nothing. It's turning into mush. So this is not a good look for real estate right now, both for traditional homeowners and for real estate investors, because the incentive to buy is fading pretty quickly. And anybody who's looking at the data we just talked about with a level head right now is going to say the only way I would even touch real estate is if it comes back down to earth, if prices actually make sense again, where I can easily afford my payment. But that means people who own these homes today are going to be selling at pretty substantial losses in a lot of cases.